what we're going to do today is talk about some practical things in relation to cash flow around businesses and understanding the cash flow and understanding how to manage it. The first key thing in relation to the cash flow in my mind is firstly figuring out whether or not you've got a cash flow issue or a profitability issue. So, and the way that we work that out is ultimately sometimes a cash flow issue is actually created by a profitability issue in the fact that the business isn't generating enough of a profit to actually support the owners of the business, and therefore the owners of the business are taking out a little more money than the profit the business is generating, and therefore creating a cash flow issue, which people think potentially is cash flow, but ultimately it's caused by a lack of profitability. So that's the first thing that you really need to figure out if you're looking at having shortages of cash. Is it a profitability issue or is it a cash flow issue? One of the key things that I think you need to think about in relation to that is, rather than if you've seen a profit and loss statement, you start with sales at the top, you then take off your cost of sales to get a gross profit, you then take off your overhead expenses to then get a net profit, and then depending on your structure, you take off income tax to get to a net profit after tax. Now, rather than think about it from that top-down perspective, I like to think of it from a bottom-up perspective. And you start with that bottom line of the net profit after income tax. And that figure needs to be the amount of money, or at least be the amount of money that you need to take out of the business to fund your lifestyle. You then gross that up and work your way upwards in relation to your income tax to get to your net profit, and then add your overheads to get to your gross profit, then your margins and things to work out your cost of sales, to then work out what your sales need to be. That way you can build a business model that's then actually going to generate the profit that you need to actually live off, which then will help you in relation to if you've got a profitability issue rather than a cash flow issue. So once you've determined that you've actually got a cash flow issue, we then need to understand, well, actually, what causes the cash flow issues? So, Ylemer, can you put up that slide for me, the first one?
Sure, give me a moment.
Yep. So cash flow issues are caused when the money generated from the profitability of your business is tied up in what we call working capital. And what we're going to do is just, I've got a little sort of diagram here to explain how that occurs. So what we're going to assume is this business is importing products from overseas, bringing it into the country, holding it. Yep, so the first one there, yep, perfect. So holding the stock, selling that to customers on account, and then the customer pays us. So initially when we're ordering and paying for the stock from overseas, it then generally, let's assume it takes 3 weeks for that stock to get to us and be put on the shelves. So we've paid for the stock, and there's a 3-week delay in actually putting it on the shelves before we can actually sell it. And then on average, our stock is on our shelves for 10 weeks before a customer pays it. So on average, before a customer comes in and buys it. So once the customer comes in and buys it, we've got customers that are on account, and generally on average, they take 6 weeks from the date of invoice to then actually pay us. So from the initial point of when we order and pay for the stock, so we outlay that money for that stock, the then delay in when we receive it and then sell it and then actually receive payment for it extends out in this example to 19 weeks. So for a 19-week period, you are funding the cost of that stock, and you need to obviously have the cash reserves or take the cash out of profit to fund that time period. So that's what we mean by working capital. So in this example, the working capital is our stock, and it is our debtors, which is the money that customers owe us. So that's what causes cash flow issues. We may be operating profitably, but we need to be taking some of that profit and investing it in working capital. Other examples of working capital are, let's say that we we potentially buy a new item of plant and equipment worth $10,000. And that's an item that we're going to be using over the next few years. And we didn't finance that, but so we've paid for that out of profit, which again is an impost on our working capital. So we may have profits that the business has generated, which has then come to us in cash, but we've then used that cash to reinvest back into the business. So that's the key crux of what causes a cash flow issue. Okay, does anyone have any questions at this stage? Nope. Okay, we'll move on then. So what we're looking at then is, okay, well, what's the best way in which to manage cash flow? And this is going to sound a really silly answer, but the best way to manage cash flow is to actually manage cash flow. And quite often, people just don't pay it the attention that it needs. So what we've got up on the screen now is a very simple tool that once you have set up, doesn't take long to update every single week, that allows you to forecast and manage your cash flow on an active basis. So what it is it's a 12-week cycle, and I'm mainly sort of pitching this towards our the businesses in Australia here. But the reason we use a 12-week cycle is because that's a cycle for our business activity statements. So if we're on a quarterly cycle for business activity statements, then we've at least got one ATO payment in this cycle, which is why we do the 12 weeks. Anything longer and we're a little bit too unknown, and anything shorter, we're potentially missing out on those quarterly transactions that can be quite lumpy in relation to the way that the cash comes out. So the way that we start with this is we start in week 1 and we start with our opening bank balance. We then head down the column and we need to add in what do we project our cash sales to be in the next week. Okay, so again, a little bit unknown because ultimately we don't know how many customers are going to come through the door. But again, we can have a reasonable sort of estimate in relation to that. The next one is the customer receipts. And this is obviously a little bit more refined in how we can forecast this, because what we do is we list down each of our customers and we know on average when customers are going to pay us because we've invoiced them already and we know their history about when they're likely to pay and those sort of things. Obviously not absolute because customers are not necessarily consistent, but again, it's a little more accurate than our cash sales. But we do it on a line-by-line basis. So, Bob's Burgers, they've ordered some stuff from us, 45 days ago, and we know on average they're paid in 47 days. So we know in this particular week they're going to pay us. So we can stick in their receipt in there. So the next one is if you have any sort of bank finance or loan funding, you can put in here if you're anticipating to receive any loan funds along the way. And the next one is if you're looking to put any money into the business yourself as well. If you know that there's potentially going to be a bit of a shortfall in cash flow and you need to top it up on a short-term basis, again, you can plug it into there to make it work. We then go to our payments. And on a receipts perspective, that's not an absolute list, but it's just a few examples in relation to the most common things that would go in there. We then go on to our expenses, and we kick things off. And again, it's just in no particular order, but we're looking at wages. So we obviously know on a fairly consistent basis, this one's really easy to project. We know who our employees are, unless we've got some casuals, of course, that's a little bit harder. But we've got our wages. So again, we can plug those into each of the weeks as we go along. The next one is your ATO payments. So we've got our PAYG withholding, which is obviously the withholding tax on our wages. And we've got the GST payments as well. So with the PAYG withholding, the reason we separate that out and we don't say BAS is because our PAYG withholding may be on a monthly or quarterly basis, and so forth with GST. It could be monthly or quarterly, and they could be on different cycles. On the next perspective, we've got loan repayments. So that would encompass if we've got any loans, they're obviously regular payments. They're pretty easy to forecast as well. On the next perspective, we've then got supplier payments. So again, we know these are the payments. We know when they're due. We've already ordered this stuff off suppliers. They've given it to us on account. We know when we need to pay them by. So again, this one's pretty easy to include there as well. Some of the other things we may include that I didn't sort of include in that simple example there could be rent payments for our premises. So again, pretty easy to estimate because they're due on a monthly basis. Leasing of assets or hire of any plant equipment, and the list can go on and on and on as well. So generally, they're sort of all of our payments that are coming out. Then we get to the bottom of the column, and we've obviously got our estimated closing balance at the end of next week. Then what we do is we take that estimated closing balance and we put it up into the opening bank balance for week 2. So generally, if you're setting this up as a spreadsheet, you'll just create a little formula, which will then obviously sum total the column 1, get to your net total at the bottom. It then transfers that balance to the top of column 2 there in the opening bank balance. We then go through the same process in relation to weeks 2, 3, 4, 5, and so on and so forth through to week 12. Now, once you set this up initially and you've got your projections out to the end of week 12, it's then just a simple case of dropping off week 1, adding a column to week 13, and everything kind of shuffles along. So you're not redoing this thing every single week. What you're doing is you're dropping one column off, adjusting the opening bank balance to the actual bank balance, and then looking at revising any figures based on change of circumstances, and obviously then adding in another week at the end of it to make sure that you're continuing to do your 12-week cycle. So you would be amazed at how powerful this tool is in giving you the foresight and the ability to manage your cash flow. What it can do is that there are quite often some issues in relation to managing cash flow. If you don't have the cash to pay a supplier in a certain week, well, then you may pay them in the next week, but that makes your supplier unhappy, and potentially an unhappy supplier could mean changes in terms in relation to when you get your goods or when you get services from them. If you're using this tool, what you can do is you may project this through and go, you know what, in week 8, we're actually going to end up with a $5,000 deficit. But in week 9, we're actually going to end up with a $20,000 surplus. So we know that in weeks 1 to 7, we're going to be fine. In week 8, we're going to have an issue. And then in week 9 through to 12, we're actually going to be fine. So what we can do with that information then is if we have a supplier payment that's due in that week that we're going to be short, we can pick up the phone with them before the amount is due and say, listen, we've just done our cash flow projections. We're going to be a little bit short in that week. Is it okay if we pay the bill 1 week later? By having that sort of conversation with your suppliers, you can then manage their expectations and actually create a better relationship. And that way you're not sort of dreading when the phone rings in week 9 that it's, ABC suppliers calling you up to say, hey, where's our payment due? We all know what it's like chasing our customers for payments. Well, put yourself in the shoes of your suppliers as well. Quite often it's really nice if you can get on the front foot, talk to them and say, hey, the payment may be a week or 2 late. And we can do that because we're managing the cash flow in relation to the way that we're doing it here. So that, in my view, is one of the most powerful ways in which you can manage and work with your cash flow. By just doing this projection, and you may change it however you want to, but by actually doing this forecasting and spending a little bit of time focusing on it, you will be absolutely amazed at the amount of difference it will make to the way that your cash flow works. Because ultimately, at the end of the day, making decisions within your business is based on the information you have on hand. And if you're not forecasting your cash flow, it becomes very difficult to make decisions about where to spend cash because you don't know what's going to happen in the future. Now, this is obviously not a crystal ball. It's not going to be exact, but as you actually work with this more and more in the future, you will get better and better at actually forecasting this, and it will actually become more and more accurate. So yeah, this is as I said, the by far the greatest tool that you can use in relation to getting a handle on your cash flow. There are some specific things that you can also do, which are a bit more tactical. One is in relation to if you have debtors that say your debtors are sitting at 90 days, well, ultimately that means that your customers are taking 90 days to pay you from the date that you invoice them. So a clear thing or a key thing that you would need to do then is create a process in which you are actually collecting your debtors. So that could include things, and we all hate making that phone call to customers to say, hey, you need to pay us. But there are systems and processes that you can set up so that you remind your customers in a less intimidating way than picking up the phone and saying, hey, pay me some money. So that could be things of, say you owe your terms in 15 days. So you send out an invoice, 15 days to pay. Let's say on the 18th day, anybody that hasn't paid gets a reminder email to say, hey, we note that your payment for this invoice hasn't been received on time. Can you please ensure that you pay as soon as possible? You then may, from that point, scale it up. So the next point after that may be sort of another couple of weeks, and it might be an increasingly strongly worded email. And then the next step may be a phone call. And then you may sort of escalate it so on from there. It may come to a point where you get to a stage where you stop work. So you obviously stop credit on them. And that's obviously the extreme end of where we would go. But simply by creating that process and having those follow-ups, what you'll then find is once you implement that, that will then actually train your clients so that they now know that they actually need to pay on time. Terms of 15 days, so they need to pay on 15 days. Otherwise, they know that they're going to be followed up for these things. And that obviously is uncomfortable for everyone. None of us want to be followed up to remind us to actually pay an amount due. Another one is in relation to managing the stock on the shelves. So ultimately, now everything that we discuss here needs to be factored into your strategy as well. So ultimately, at the end of the day, if you have a strategy that you want enough stock on the shelves so that when a customer comes in, even if it's a rare item that they order, every time they come into your shop or location or warehouse, or every time they order, that particular item of stock is there and it's on the shelf and it's ready for them to go. If that's your strategy, then managing your stock needs to be very carefully considered with that strategy. So ultimately, the more stock that you hold on the shelves, the more money is tied up in that stock. So ultimately, what you want to do is if you want to free up cash flow, you need to maybe cut the levels of stock that you have on hand, but you need to be wary of not cutting it too much, that you then have instances where you're out of certain items and that then impacts on your customers and the service that you're delivering. So now again, the best way to do this is actually by managing it. Quite often some people think about their stock and they think, okay, well, I think that's what I need and when I need to order and all those sort of things. But again, if we can create systems and processes that then actually you're aware of, well, let's say we want to keep 1 month's worth of stock or let's say 2 weeks worth of stock on the shelf. We then need to know, okay, well, at what point is our reorder point? So we then have maybe a software system that manages the stock. When it gets down to a certain level, we know, bang, we need to reorder and away we go. Obviously, depending on the size and scale of your business, that may be difficult, but something that we can do in relation to that. In relation to, obviously, the Ato payments, they're very lumpy. And again, can cause some issues in relation to we may not have put aside enough money for that those Ato payments as we go. You can call up the Ato, make payment arrangements, do all those sort of things. Again, trying to smooth out that cash flow to make sure it's easily managed. There's also the recognition that you may actually need to reinvest in your business, especially if you're growing your business. If you're growing your business and you need to be adding more stock and you're getting more customers, more sales, therefore more debtors, this growth of the business requires an investment in working capital. So you need to recognise the fact that you may need to reinvest back in your business. So you can't take out every dollar of profit in relation to the money that you want to live off. So again, if we go back to that that scenario before where I explained the bottom up. We start with the profit after tax of our household budget of what we want to live off. Well, maybe we need to add into that household budget an investment or a reinvestment in the business in working capital. And then we start up from there, and we then work out how the business needs to be structured in relation to make enough money for us to live off and enough money to reinvest back into the business as it is growing. However, one of the most powerful and common forms of managing the cash flow is about seeking finance. And essentially what we're looking to do is, and plenty of banks have products around working capital finance. So some of those products, they offer trade finance. So when you order that product from overseas and you have to pay for it up front and it doesn't hit your shelves till, 3 weeks later, and you don't sell it for another 10 weeks, and then you don't collect for another 6 weeks. Well, if we could get a revolving finance facility, which gives us 20 weeks of finance, we can buy that stock, finance it. We get charged a little bit of interest, but we don't have to pay back that trade finance until such time as we've actually sold those goods, made our profit, and collected the money from the customer, which means we've then got that cash to pay, and it eliminates that cycle. Another popular product is what's called debtor financing. And essentially what that does is, when you invoice a customer, what the bank will do is they will then give you 80% of that invoice value. And again, they'll charge you a bit of interest. But essentially what happens then is the customer then pays back the bank take their interest, take their fees, and then they give you the balance of the 20% left over from the original 80% that they gave you when you initially sent that invoice. Now, there are some fairly heavy restrictions in and around debtor financing, and you need to be very careful about the terms and conditions, especially if you've got some debtors that maybe pay you outside of 90 days, because at the end of 90 days, if the customer hasn't paid, well, then you need to pay back the bank the 80%, because they don't want to obviously carry debts beyond that. So there are just a few of the ways in which we can manage cash flow. As you can see, there is a vast difference in most businesses between profit and cash flow. And Ylemer, if we can just bring up that first slide there again, please. Oh, maybe we don't have that. So, the difference between profit and cash flow. Here we go. So obviously, when we make profit, it's based on purchases and sales. But when we look at cash flow, it's about money in and out the door. We haven't covered today the investment in plant and equipment in too much detail. But again, that's another way in which we can manage cash flow. If we're looking to buy a bit of plant and equipment, rather than paying for the whole thing up front, we can go to the bank and seek finance in relation to that as well. But the key thing is to understand, are we earning enough profit to fund the business on an ongoing basis and to fund their lifestyle outside of the business? If we're ticking that yes, and we've still got a cash flow issue, we then need to look at how are we managing the cash flow issues in relation to our business, which is highlighted by the example that we have on the screen there. Ylemer, if we then flick to the second one. So the key thing then is to make sure that we manage the cash flow by forecasting it and keeping an eye on it. That's the best way to do it. And we've then covered off on a few tips and tricks in relation to managing that cash flow through other ways, seeking finance, talking to our customers, talking to suppliers, and generally just managing payments in relation to that, so we're not running short of cash all the time. Thank you for your time today. I'm going to hang around for some questions, but it's been a joy. I love imparting knowledge to business owners that will really help them to grow and move forward in their business. But thank you for your time today.
Thank you very much, Robert, for the amazing information you have shared with us. I do have actually a few questions, but maybe let's start with if anyone else in here want to ask a question, please go ahead, and then I will bring my question later.
All good. Yeah, that was very informative. Thanks, Rob.
Oh, excellent. Always good to get to an end of a presentation. You don't have too many questions. It means you've covered the content pretty well.
Yeah, for sure.
You definitely covered a lot, but I'm sure that we have a lot of knowledge to extract it from you, and I will do my best to extract this information.
No worries.
I'd like to bring forward a question, especially for early stage startups, Robert. Startups, I myself, I've been through that, and I never realized the importance of cash flow. How can we predetermine that this will be something will be coming up, and we need to manage it beforehand? So we need to realize it and we need to manage it. So what does it mean for early stage startups?
Yeah, early stage startups, actually, I put up that table about that 12-week cash flow forecast, and that's certainly that's a day-to-day tool. But if you're an early stage startup, especially in the early stages of revenue, then the cash coming in is either coming in from yourself or other investors. So the key thing there is what you need to determine is at what point are we going to get enough cash flow coming in to manage the expenses of the business, to at least achieve the break-even point. Once we figure out, and let's say that's 12 months, what we then need to do is we need to then forecast on a month-by-month basis what's the next 12 months of cash flow look like from paying money out the door. So what wages do we need to encompass? What rent are we paying? What legal fees, professional fees, what marketing expenses, what hosting fees for our computer, subscriptions and all those sort of things. We need to determine on a month-by-month basis what's going to be our cash outlay over the next 12 months. We then need to determine what's our starting bank balance need to be to make sure that we get through to the point of when we have enough money coming through the door to then cover those expenses so we don't need to tip any more money in. Now, obviously, that's a hard thing to do, but I see so many startups that just get stuck into it without doing that, at least even trying that forecast to determine how much money they're going to need until they get to a point where they're going to have customer money then funding the business. So the number one key thing to do is how much money am I going to need to the point where my business is then going to break even? And that break-even point is not the end of it, because at the end of the day, that just means covering costs. That doesn't mean paying the founders who are working in the business, unless they're drawing a salary, and we've already factored that in. But ultimately, we then want to make profit beyond that as well. So, but determining how much capital needs to be invested in the business to get the business at least to that break-even point. And I'd often argue that you actually probably need to allow a scope of error in that, or a margin of error in that, because ultimately plans don't necessarily go to the rule. So we need to make sure that we've got a contingency there in case things don't go to plan.
That's a very good point, Robert. Thank you for that. So, as he said, that things don't go as to plan. So definitely that is correct. Early stage companies, myself, been through that before, especially when designing the business model. It keeps shifting. So the more that we collect more information from the market, the more that we find that we need to adjust our business model to adjust to the market. So don't you see that it can be really extremely difficult for entrepreneurs in the very early stages to have a concrete projection in aspects of the finance and the expenses?
Yeah, it's really about achieving balance. So you can spend a month putting together 12 months worth of cash flows that are really accurate. You've done a whole heap of research, but you've spent a month on it. And is there enough value in that 12-month projection to spend a month of your time? But then at the same time, you don't want to spend 2 minutes on it, making up numbers on the fly and just piecing together something on a bit of paper. You want to achieve a balance between the time and effort that you need to put in and the result that you're going to get out of it. And there's a happy medium there somewhere in the middle where you spend enough time to get it accurate enough that it's meaningful, but you're not spending a huge amount of time that could be better spent developing and building your business forward. But it is definitely something you do need to spend some of your time on.
This is a great advice. So from what you are saying, I can see that work on your product or work on your business while you at the same time keeping track of the expenses that you are making. So keep track of all the expenses, putting it together as you progress along. You still have this information in one place. I actually did that myself. You have it in one place, and then you start to adjust as required as you move along. Is that correct?
Absolutely. Today we're talking about cash flow, but equally as important is actually tracking your financial results. So, keeping on top of the income coming in, the expenses going out, the position of your cash flow, the amount of stock you've got, the amount of money that people owe you, having a handle of your finances, again, gives you the ability to then make decisions. So not only do we need to project forward and see what we think we're going to achieve, we need to be keeping a close eye on what we have achieved and where we are right now to ensure that that we're doing the right thing and making the right decisions. I quite often use an analogy. If you flick on and you're watching your favourite sports, let's just call it rugby league, you flick on the TV and you're watching rugby league and they don't have the score in the corner. You're watching the game. Your team goes in. They score a try. You want to get excited, and you are excited because they scored a try. But if the score's not on the screen, you don't know if your team is 50 points behind or 50 points ahead, or if they're even and they've just scored a try to put them ahead. Ultimately, if you don't have the score there, you don't know what's happening. Now, imagine that you're not watching the game, but imagine you're participating in the game. And you don't know what the score is, and there's 10 minutes to go. And you don't know whether you need to go on the attack, really defend hard. You don't know what strategy you need to employ to win the game because you don't know what the score is. Now imagine that you're sitting at your desk in your business and you're making a decision about tomorrow, next week, next month, next year. So you're making these decisions going forward in your business, and you don't know what the finances of your business are right at this moment. How can you then make a meaningful decision about where to go with the business moving forward if you don't have a good handle on how the finances sit? So quite often I just use that a bit of an analogy to highlight the importance of getting an understanding and tracking the finances of what's going on. Sorry, Ylemer, I sort of diverted there a little bit as a thought came to mind, but hopefully it was good information.
You actually make me to visualize it. I could imagine I'm looking at a footy and there is no score. How ridiculous that can be! But imagine that you are yourself in the game and you have no idea what's going on. You need to slow down or you need to slow up. It's definitely like a very accurate metaphor. Thanks for that, Robert. So
no worries.
So Robert, moving back to the cash flow, how can we control the process? So looking at the graph that you shared with us earlier, the life cycle of the sale until you have the cash in your bank, 19 weeks, so about 19 weeks duration. Is this a standard life cycle between the invoicing and you getting paid, or is there any way that we can adjust this, or is this flexible, or that's a standard?
No, so that was just an example, and that was an example based on somebody ordering products and then obviously getting product in, putting it on the shelves and selling it. Let's say that you've got a software as a service business. Theirs is very different sort of working capital that they invest. Because they have a subscription service coming in, they've got a monthly payment due and those sort of things. but the working capital that they may invest is wages for their software developers in developing new features and doing all those sorts of things and new releases and that. The life cycle is very dependent on the business and the business strategy. Let's say, for example, I used an example there of 19 weeks, but I have a particular client, they're fairly large, and when they pay the supplier to order product to when they receive payment from their customer, because of the style of their business, on average, it is actually close to 200 days between the first payment and receiving payment from their customer. So their working capital requirements are enormous. But the strategy of their business is that they want to have enough product on the shelf that if a customer orders a particular product, and even if it is something that only gets ordered once every couple of years, they've got it there sitting on the shelf because they're in a particular industry where when their customers need this stuff, they need it now. And so they invest that amount of money in their working capital because it fits in with their business strategy. So they need to then tailor their financial strategy to make sure that we can fund the business strategy with the working capital that's needed. But that life cycle, if we look at a fruit and veg shop, their cycle is not going to be that long because their product is perishable. It sort of, within, let's say, a week, the stuff goes off. So, and when customers come into a fruit and veg shop, well, they're paying cash. So we've got no debtors. We've got a very short period of time where our stock sits on the shelves. Therefore, we've got a very minimal sort of requirement for working capital in relation to those two items. So the cycle will be very different depending on each different business.
So it depends on the business model, and it's also depend on the size of the paycheck. Is that correct?
Yep. So the size of the business, the scale, the business strategy, the business model, and also the funding capability of the owners. So, if you've got some owners that have a fair bit of cash in their own name, well, then they can then use that to fund that working capital. If you've got owners of the business that don't necessarily have those sort of finances, then they may need to go to other sources such as banks or other third-party lenders to then fund that working capital of the business. Or if you like quite a few businesses around Australia, you could use the ATO as a bank and not pay them when they're due. But ultimately, that's a very short-sighted strategy. Quite often involves a few phone calls from the ATO to say, hey, you need to pay up. But as an interesting point to note, one of the biggest petitioners for insolvencies in Australia is the ATO. They're quite often the last to be paid because ultimately, paying the ATO late, you're not hurting that relationship. Whereas paying one of your key suppliers late, well, then you're annoying your key supplier, which then could hamper your ability for them to supply you or their willingness to supply you. So ultimately, we tend to gravitate towards paying the ATO latest. And generally, depending on the time of year, they're somewhat a bit lax in chasing. So we know that we're not going to get phone calls of angry people chasing us. But ultimately, So ignore the tip about delaying ATO payments. Not a good strategy.
So, if from what I'm actually hearing, that there is it's a close to B2B. So this cycle is more close to B2B, not as business to customer. So there is a big difference between businesses who serving customers and businesses who serving businesses. Is that correct?
Not necessarily. So let's think about a large supermarket, which has a lot of investment in infrastructure. So, a lot of shelves that need to be put there, cash registers up the front, and they need to have a lot of stock on the shelves. So there's a fair amount of working capital there that's required, even though you've got customers paying cash as they leave the shop. So debtors are just one, stock is another. If we look at a service business, let's say we've got a real estate agent. Okay, so everyone will be familiar with a real estate agent. So what happens is somebody wanting to sell their house. So I want to sell my house. I go to a real estate agent. The real estate agent does up a marketing campaign. They put a bit of advertising online, say realestate.com and those sort of things. At that particular point in time, the real estate agent is paying their staff to do appraisals, to get leads, to get listings. And then once they get the listing, they then need to show people into the house. They need to advertise. They then need to negotiate a sale price and a contract. And then that contract, once signed, then needs to settle after a period of time. There's access that needs to be granted to do building and pest inspections and all those sort of things. So we're paying wages and all these expenses. And as a real estate agent, we don't get paid until that sale settles. So from the first instance where, say, a real estate agent comes out and does an appraisal of my house, and then a few weeks later I decide to list, and then the listing is listed for then a month before it sells, settlement then happens 6 weeks later. So there's a period of time where I've incurred all of those expenses before I actually get paid. So there are various differences in relation to working capital. I chose the product and stock on the shelves example because it's the easiest one to explain. But like the real estate example, like, accountants, we spend money, we spend time doing work for clients, we pay the wages, we bill the client pays us later. We've got that working capital in relation to the time that we have paid our employees to do the work to then on charge to clients. So there's lots and lots of examples of working capital in businesses.
I see. So it's the upfront investment prior getting the money in.
Yep.
So is there anyone in here, Carl, Ella, or anyone got a question about your business model and how can you benefit from this conversation into what you are doing? Please bring it forward.
Hi, I'm Ella. I'm actually from Indonesia. So what I want to ask is, I'm working in a startup. Is more in service, a digital agency. So all our working capital should be for employee, right? Right now, but because of COVID, we have a lot of trouble with payment, and we also have an ongoing client, but they drop out because of COVID. And right now we have no balance between income and expenses. What your take on it? I mean, how can I fix my cash flow to create a better, stable cash flow for the company?
So from what you said there, I'm getting the impression that's not a cash flow issue, it's a profitability issue. So if we've not got enough revenue coming in to cover expenses because of the drop-off and those sort of things, then we need to fix our sales to get more money through the door, or we need to look at our expenses and say, how do we get, if we can't get more income coming through from customers, how do we then restructure our expenses so that we've got whatever revenue we have at the moment coming in to cover that. So, and then once you've got that sorted, if you've then got a delay with when you invoice and when your customers pay, you then need to look at, okay, well, how do we implement processes and how do we have discussions with our customers to make sure that they pay more promptly? And then the other thing as well is to consider is if we've got this cycle about we're paying the wages, we're trading profitably, we're paying the wages, and there's a delay between paying the wages and invoicing customers and getting paid from customers, how much money are we going to need to cover that shortfall, and how are we then going to find that money either through profit or through investment or finance to then stick that into the business so we no longer have a cash flow issue.
Yeah. Previously, we only pay our working capital, pay our salary and all our expense through profit, right? But the past few months, I think I see, so you said we need to make a projection. Before 2020, I already make a projection for like 2020, 2021, but it's all changed. And yeah, it's all changed. And is it, when is the time that I have to go to my founder, to my my founder, that we need investment injection?
Well, what you need to do is, if you've already done your projections but everything's changed, well, you need to change your projections.
Yeah.
So you need to. So where I would start is I would go to a as I was telling Ylemer before, I would go to a 12-month projection, month by month, and I would look at what revenue do we expect to receive, what are our monthly expenses. On the revenue side of things, when do we expect things to pick back up again, and on what scale? And then I would go through and go, okay, well, this is what I think we're going to do over the next 12 months. What's the shortfall? And then that's the figure that you need to go back to your founder and say, we need at least this. We may need more if the projections don't go quite to the way that they need to. And then if he says, well, I don't have that much, I've only got this much, we then need to go, okay, well, how do we push the revenue side things higher? Or alternatively, if we can't do that, how are we then going to manage our expenses to make sure that we fit inside the bubble that we're going to need to do? Sometimes it takes some really tough decisions to cut out some expenses to save the whole business. If we keep expending the money that we're expending and we don't have the revenue to cover that, then the whole business is going to go under and everyone's going to lose out. But if we can restructure our expenses, then maybe a business here or an employee there may lose out, but everyone else still gets to stick around. So sometimes we need to make those tough decisions to ensure the longevity of the business.
Yeah, I think that's the problem. The tough decision is our expenses is our employee, that we need to run the business. So it's like a chicken on egg situation.
Yeah.
We need the client, but we also need the employee. So yeah.
So, now what you've got to look at is if it's a headcount problem and we're spending too much money on our headcount, I would suggest you start with who are the employees that best fit the company vision and the company strategy and the company culture. Yeah. Who are the best people that align with the long-term outcomes of what we're looking to achieve? They're the people that we need to hang on to. If there are people that fall outside of that, then in my mind, they're the first ones to go. If nobody fits into that, if everyone is in the first bucket and they fit in with all of that, then you need to look at, okay, look at the current performance. Who's performing, who's not performing? Again, if you've got great performers and maybe some people who aren't, then we let go of the ones who aren't. If we've got a situation where we've got everyone performing, everyone sits in with the long-term vision of the business, then what we can potentially do is say, rather than let one or two people go, we could say, okay, well, what we're going to do is we're going to cut everyone down. Rather than working full-time, we're going to have everyone work a 9-day fortnight instead of a 10-day fortnight. Or we're going to have everyone work a 4-day week instead of a 5-day week. And so then everyone, I guess, endures a little bit of pain in the short term till revenue comes back up, and we can then employ them back full-time, and we've still got everyone on board, and we've still got that culture, and we've still got those people that fit in with our long-term vision.
Yeah. Thank you for that. I think that's what we need to I need to discuss with the founder because it's been a struggle the past year. So yeah,
Yep, and
thank you.
absolutely by looking forward and redoing your numbers and determining, what do we need to do to survive, not only through this downtime, but what do we need to keep in the business to make sure that when things improve, and they will improve, when things improve, how can we then take advantage of those improving conditions to then continue to grow like we were before COVID hit?
Yeah. Okay, thank you.
Sorry, just one quick one before you step in. So, at the end of the day, if you're an Olympic swimmer, you don't cut off your arm to shave a bit of body weight, because at the end of the day, you need your arm to keep swimming. It's the same thing in business. You don't cut out key employees that will hurt the long-term aspects of your business just to save some short-term cash. So ultimately, any cost savings that you look at must be strategic. You must not sacrifice your long-term strategy for short-term cash gains, unless, of course, you're desperate and absolutely have to. But ultimately, where you can, make sure that you try and keep all the things about your business that make your business yours.
Yeah. Thank you for that.
That's amazing, Robert. So you actually touch on multiple things. So we talked about other things rather than cash flow and finance or accounting. We talked about strategy. So it seemed to be from the conversation that actually the strategy and reliability on the headcount or the staff, it can impact the business dramatically, and if either positive or negative. So therefore, the decision must be taken from there to adjust the cash flow. So Robert, if let's say Ella came to you and asking you that she want help, what are the things that you will implement to work with her and to help her business to stand up again, even after a whole year they were struggling after as she mentioned. What are the things that you will be looking at and how you will be able to transform the business? So as an example.
Yeah. So the first thing you need to look at is, and I'll come back to it, is about the strategy. It's about the vision and the strategy of the business and what do you want that business to be in the long term. You always have to have sight of that anytime you're looking at making any changes within the business. It is the overriding thing and the most important thing as to where you go moving forward. If you're clear on that, you then need to go, okay, well, what's the strategy then that we need to do to survive the next 1 month, 6 months, 12 months? What do we need to do in relation to making sure that the business gets from now through to the point in 12 months' time when things pick up again and things get better? How do we need to structure the business, the expenses, the financial model, everything to make sure that we survive? And so it's a case of making sure that the changes you make tie in with that strategy, tie in with those overall objectives. So, for example, if you're a high-end boutique shop that's selling, dresses to wealthy individuals, and you've got a prime position in the central business district of your location, it's prominent, it's there, it's in a beautiful shop, but you're paying a huge amount of rent and you've got less people coming in and buying your products. You could sit there and go, well, to survive, my biggest expense is my rent. Therefore, I've got to move location. So I move, a kilometre down the road to this really dingy shop that's got dodgy walls. It's in a bad neighbourhood. It's got really poor lighting. And ultimately, at the end of the day, but I'm going to save a hell of a lot of money in rent. But the problem is the wealthy individuals that go in and buy these high-end dresses is not going to go to that location to buy that product. So that's a change that we would make that would be absolutely at odds with our long-term strategy and who we are as a business, and therefore would create a problem in relation to surviving. You may survive the next 12 months, but you probably won't survive beyond that, because all of your long-term customers would go, you know what, I'm not going back there because I just didn't feel comfortable buying a dress of that price in a shop like that. So understand the high-level stuff, and then let that filter down to the strategies and the actions and the implementation to ensure that you're living the business that lives up to the vision that you have for it.
Thank you, Robert. So, Ella, please take advantage of our free consultation with Robert. If you go to the link that I shared in the chat, you can access Robert's profile on our website. If you will not be able to request an initial consultation, just to contact us, and you will be able to have a chat with Robert and see in what way he will be able to assist you, or at least you will end up with an advice that will definitely help you and your business. So please have a look at the link in the chat I shared, and reach out to us anytime if you need any help.
Sure, thank you.
Thank you. So, what about Carl? So Carl, he has a new startup and he just got funded. Carl, do you want to talk to us about that? And is there anything that Robert can help you in any way?
Yeah, sure. So yeah, being a startup, pre-revenue, so I suppose there's two business models we could work with, and that's to produce a commodity like the microalgae and do offtake agreements, or to sell the technology, license it, or sell the actual bioreactors for other companies to grow the microalgae. So we're still not quite sure, because we're still working on a technology. I suppose it's more of getting that market understanding of the best way to move into that market, whether to be a technology company or a commodity company.
So ultimately, I'd think about what is it that you're passionate about, and what is it that you're really good at doing, and so you need to, and that then forms the crux or the central core of what your business is about. And then once you understand that, that will then lend itself to pointing you in the right direction as to which way you want to go in relation to the business. So ultimately, at the end of the day, if you're about developing the technology and you want to work on that and continue to evolve it and develop it and do all those sort of things, but you don't necessarily want to worry about dealing with end users and all those sorts of things, then ultimately you potentially go to a business-to-business model where you develop your technology, and then other businesses then sell it to or use it for end users and all that sort of stuff. Whereas ultimately, if you want to engage in the life cycle and you want to deal directly with those end users that are potentially using your technology and doing things, and you want that interaction and all that sort of stuff, then you potentially sort of go down that path. You need to sort of look inside yourself and go, okay, well, what is it that I really want to do with this business? What is it that I'm passionate about? And what is it that I'm really good at doing? And ultimately, at the end of the day, you look at the overall strategy that fits best with you. And even if there are some talent gaps in some of the stuff that you need to do, but that's the direction you want to go, that's where you employ people with specific skills to fill those gaps. Yeah. So don't necessarily go down one path or the other because you say, well, you know what, I don't really like dealing with that side of things. But if doing things that way is best for the overall strategy of the business, then we need to go that way, and you just then bring in the talent to help you with those things that you don't want to deal with or you're not good at dealing with it. Does that help?
Definitely. Yeah. Really good. Yeah. Especially the part about the passion, following your passion, and because that's where my drive comes from. And if it's just to supply end goods or something like that, and it doesn't really do it for me, then why am I in business then? So it's about really following your passion.
Absolutely. Yeah. And I've recently sort of set up my own accounting firm after 20 odd years of working in other firms and large corporate firms and that sort of stuff. I acknowledged and come to a realization that I figured out what I was passionate about and what I wanted to do and the sort of customers I wanted to deal with. And I'm creating a business that I can do that. And I've got to say, over the last 12 months, I have not been happier in my entire working life, simply because I'm aligning my day-to-day, most days, not all days, but I'm aligning most of my day-to-day with my passion and what I really love doing. And honestly, it feels fantastic when you get that mix right.
Yeah. Thanks, Robert.
No worries.
Thank you. So definitely, we've been through that. Even myself, Robert. Like, there is nothing more rewarding than having something that you can see it growing. But we all know that it's extremely difficult, and this is why we decided to build Ylemer, because we know that how difficult it is to build a business. It's extremely difficult in many aspects. No one knows everything, and basically this is why we built Ylemer, so we can help the business owners and entrepreneurs to overcome most of the challenges with amazing people like yourself, sharing knowledge as much as we can, so we can enhance the economy overall. And also it's for the mental state for our society as well. There is nothing worse than having a job that it's not fulfilling your human being or your uniqueness. So anyone in here, again, feel free to reach out to us. We are here to help. We are only here to help. If you reach out to us, we will definitely find something to do to assist you in whatever stage you are at. So please feel free to reach out to us, www.ylemer.io, and just give us a call or send us an email, and we will be able to help you in any way. Robert, this has been a great session. Definitely, you promised that it's going to be a fantastic session, and here we are. Everyone end up with something that definitely helping them in one way or another. So thank you very much.
Thank you, everyone, for attending. It's been a pleasure.
Thank you. Anyone in here have any questions or want to bring anything to the table? We'll be happy to discuss it. Okay. Robert, again, thank you very much. It's been great having you, and I will look forward more collaboration from here.
Okay, excellent. Catch you all later.
Thank you.
Thank you.
Everyone.
Thank you, everyone.